Welcome to Ben's Market Insights. This is going to be the last one of the year, so wishing all our viewers and listeners a very happy Christmas with family and friends and a very successful investment environment in 2026. Today we're going to talk about the big beautiful bill and the implication for liquidity in the first quarter. We're going to talk about US inflation, we're going to talk about UK rates and the attraction of the Japanese yen at this juncture. We're also, on a micro note, going to concentrate on prediction markets. What are these? Who is playing in these? And why should we care? And then a comment on what has been a pretty lackluster year for Bitcoin. And we'll have a little discussion about that. In the meantime, if you're enjoying this content, please give us a thumbs up and subscribe to the YouTube channel and onto our various podcasts as well. Thank you very much for that. So let's delve in. The big beautiful bill releases something like $150 billion in tax credits that are retroactive payments from the 2025 earnings. That all comes through to consumers and households and corporates in the first quarter of next year. That's a nice lumpy bit of liquidity, which I think is certainly going to continue to make risk markets at least quite attractive. And we've talked about why we think risk markets are going to be attractive anyhow for much of next year, certainly first quarter and second quarter, partly thanks to what looks like is going to result in a dovish Fed governorship, resulting in lower interest rates, much more than probably required. Putting a bit of a damper on that, though, is that the US inflation figures that were just released suggested that November inflation came in at 2.7%, which is better than the 3% that was forecast. But I think we need to put that into context in as much as this came in at a time when we had the shutdowns, the government shutdowns, and that restricted demand and restricted consumer activity. My suspicion is that we start to look at December and January inflation numbers, those may well kick through 3%, and again put some pressure, possibly delaying those interest rate declines. But nonetheless, a delay might be just that, and in fact interest rates will continue to head lower as we head towards the latter part of the first quarter. This big beautiful bill is releasing something like $4.6 trillion in tax cut extensions over the next 10 years. Very expansive. The negative is that we've got almost $1 trillion cut to Medicaid, which is affecting some 24 million consumers. That is still, sadly, only 7% of the population, and also is not really affecting the mass of the consumer base that would be relied upon to continue the momentum in consumer spending, given that those consumers that are going to be missing out on their Medicaid payments are at the bottom end of the consumer pyramid. Let's look at UK rates. The Bank of England have reduced interest rates to 3.75%. The economy is not growing. Is this going to be sufficient? I don't think it will. Unfortunately, what appears to be the case is that the fiscal deficit is so large that the government is going to have to continue to borrow in order to be able to meet the fiscal gap. This is not going to come out just purely from tax. If that's going to be the case, then the bond market, the government bond market, has got to remain very attractive. And if that's going to be the case, that means that sterling has got to be at a relatively strong position to attract those foreign investors buying UK bonds. If we have that, the only way we can have that is via interest rates remaining relatively high to other economies. If that's going to be the case, 3.75% could be the bottom. It's very unlikely the Bank of England can afford to reduce interest rates any further into 2026. If it tries to do that, I suspect there's going to be some pressure on sterling as a consequence. On the other side of the ledger, you have the Japanese central bank, which has just raised the base rates to 0.75%, and a former member of the rate setting committee in Japan's central bank, has suggested that the current governor's wish is probably likely to imply a 1.5% base rate by the end of 2028, before 2028, when his tenure expires. That implies a further doubling in rates, making the Japanese yen pretty attractive. And when we look at it on a global basis, I think that actually 2026 will see a weak US dollar, relatively weak sterling, but a strong Japanese yen. So a long yen, short US dollar trade is probably a central feature or a carry trade that I think is worth thinking about. So let's now move to sort of the micro part of this discussion, which is concentrated on prediction markets. What are these prediction markets? What's going on? Why should we care? Well, let's describe what they are in the first instance. A prediction market contract is effectively a bet that an outcome, a binary outcome in the real world, and that implies results of elections. Who's going to become the governor of the Federal Reserve? Who's going to win Saturday's game at Arsenal? Anything that has a potential outcome can have a prediction market contract set against it. The way the contract works is that the more people that believe a certain outcome is going to occur, the higher the price of that contract is going to be. So you're able to buy a contract between $0 and $1. If you're buying a contract at 60 cents, it means that there is a 60% chance of that event occurring. If you are buying a contract at 95 cents, then there is almost certainty that that outcome is going to occur according to a crowd of investors that are looking at that outcome, in which case your likely benefit is very small compared to the risk of that outcome not occurring. So you lose the entire 95 cents of your money. Why does this matter? According to a research body called Ehlers and Krejcik, this market is going to have some $1 trillion of volumes before the end of this decade. This prediction markets environment is really coming together as the intersection of financial markets on the one side and traditional gambling on the other, across multiple sectors. And so there are many, many players, which we'll touch on in a moment, that are getting involved in this marketplace. Also, because there are no betting and regulatory laws associated with prediction markets, margins are incredibly strong. And again, according to Ehlers and Krejcik, these businesses carry these contracts carry a 25 to 40% margin for the platform that hosts these prediction markets. Sports, not surprisingly, account for some 44% of the entire category. And the prediction also is that the current $2 billion of revenues that the sector is creating is going to increase fivefold before 2030. So who are players in this market? Clearly, the ones that get affected the most are the betting houses that are potentially losing out against these prediction players, partly because they hadn't acted quickly enough, and partly because of the regulatory environment that they face, that the prediction market players don't face. However, having said that, the likes of Flutter, Entain, DraftKings are all getting involved in the prediction market area, and that should benefit them because margins are higher in those areas than they are in their traditional businesses. Financial companies are also getting involved. So the likes of the online brokers like Interactive Broker, Robinhood, are actively involved in prediction markets, and it's becoming one of their fastest growth areas. Indices and the markets that create the indices are also benefiting and releasing platforms that allow for prediction market to trade on their platforms, and that includes the Chicago Mercantile Exchange, the CBOE, which is where the options trade, and this is a little bit like a futures contract. But what's very interesting, it's unlike a futures contract which is based around financial assets and commodities. This is very much about pretty much anything. And lastly, but also quite interestingly enough, it's also bringing on board the likes of Coinbase in the crypto world that is using their risk-loving customer base to also offer a prediction markets environment. Now, so I think that overall prediction markets are set to grow very fast over the next 2 to 3 years. They open a market and they are the intersection between finance and gambling. There is no sufficient regulatory oversight currently, and that's a risk, and certainly something that potentially we should, as it grows, it's more than likely that it comes under the auspices and the oversight of various bodies, including the gambling commissions, plus the financial ombudsman and financial oversight platforms such as the SEC and the FCA in the UK. Having said that, there are certainly going to be those winners coming through, and mention a few names in that respect. Let's now move to the cryptocurrency market. It's been incredibly dire year for Bitcoin. Bitcoin is down some 15% year to date. Compare that to gold, which is up some 65%. It's always been compared to gold, as in it's an uncorrelated asset. I think this year has blown that concept apart, and I think that there are a number of factors involved here. First and foremost, I think this idea that somehow Bitcoin and cryptocurrencies generally are uncorrelated to equity markets in the way that potentially gold is nonsense. In fact, what's very likely is that the cryptocurrency market has shown itself to be very correlated to very risky assets and very much a NASDAQ almost related type of play. And within that, I would say it's almost correlated to the non-profitable businesses that are very much more binary in their outcomes than we have sort of previously expected. So I think that certainly that thought that it's an uncorrelated asset is nonsense. Put that to one side. I think also what's happened is that because of the Trump effect of opening up the cryptocurrency market to more players and the introductions of equity traded funds that cover Bitcoin and other coins within them, has created a sense of fractionalization. And that fractionalization means more people are getting involved. If more people are getting involved, that increases the volatility. And in fact, this latest weakness from $120,000 of Bitcoin down to the current 65,000 is largely due to ETFs pulling and sucking liquidity out of the system as investors have been selling and getting concerned about the current environment within Bitcoin and crypto generally. So I think fractionalization has actually been bad at this juncture. And touching on that, on the other side of that, liquidity in the cryptocurrency market is very thin. It's very difficult to understand who owns what, but a lot of investors tell us that there's something like 90% of the Bitcoin market is held by 1% of the investors that are active in the marketplace. So I think that this is something to keep in mind, and that means that we're really only playing with marginal liquidity, and that marginal liquidity is turning into a very volatile environment. So I also think that there is an element that because Bitcoin is correlated to risk assets, and because we're suggesting that liquidity in the first quarter is subject to partly this kind of big beautiful bill element, but also partly due to interest rates continuing to decline as we get a dovish Fed, then maybe those risk assets continue to perform well. And if that's the case, you might well see a revival in the Bitcoin price early in the year. But don't mistake, the element about that it is a risky asset. It's not uncorrelated. It's very much correlated to higher risk tech stocks effectively. I'll stop there. I wish you all a very Merry Christmas and a very Happy New Year, and see you all in the new year.